Now, it's Thursday Finance with Stephen Pritchard, certified practicing accountant and financial advisor.
Welcome along to Thursday Finance. Stephen Pritchard, of course, another guest you've got for us later this afternoon.
Yeah, we've got Jack Lowenstein from Morphic Asset Management. He's the Chief Investment Officer, and he's going to talk about ethical investing, or as it's sometimes known now, responsible investing. So he was one of the first fund managers in Australia that actually had an ethical investment portfolio back at the days at Hunter Hall.
Okay.
So he's going to talk about that a bit later.
So he's gone ethical back in the Wild West days, the cowboy days.
One of the few people before the term was...
with a lot of these things
it's a lot
too.
of perception, yeah.
Good afternoon to you, Jack.
Hi, Jack.
How are you?
We're good. So I thought today we're going to talk a bit about ethical investment and the new term responsible investment. And I thought we'd get you as being one of the earliest adopters of ethical investment back in the days of what was that, Hunter Hall?
Correct. Yes. Yep.
Yeah, and that was quite a good fun when you were the chief investment officer there. So I thought we might talk about the difference between responsible investment styles and ethical investment styles to start with.
Yeah. So responsible investment is basically the umbrella term that covers all kinds of investing, from things like traditional ethical investing, which focused on avoiding bad industries like gambling and tobacco. That used to be called ethical investing, and it still carries that name quite a lot. And then that evolved into a broader thing called ESG, which is environmental, social, and governance investing, where you try to avoid bad companies, but you also try to invest in companies where you saw progress in things like governance. So a company that had bad corporate governance but was clearly improving was a positive thing you try to invest in. So that was a bit of the wrinkle there. Yeah. And then, and more recently, you've had this concept of what's called sustainable investing, which is where you try and identify companies in industries that are doing things that will make the world a better place. So not only do you avoid the bad guys, you try to actively invest in the good guys. And that used to be called positive screen investing, and now the name they use for that is sustainable investing. And that's if you like, the broad church is responsible investing, and the different sects or religious denominations are ethical, ESG, and sustainable. But they have some crossovers between them. Okay,
and so what's the impact investing? Can be ethical or unethical, basically?
Yeah. Impact investing is like a softer version of sustainable, but with the additional element that you're really doing the investing to try and channel capital into things you think will make the world a better place, but with perhaps less consideration for whether you'll actually make money from them. So it's like if I put it simply, it's like a charitable donation. In a structure where you might make some money, but if you don't worry about it too much.
Okay, so that's like a lot of those church deposit funds they kind of run, that people deposit money with them to further the church's causes. And then there's philanthropy.
Yes, philanthropy. Well, that's just basically giving your money away. Yep. and of course that sometimes, quite often, has a tax benefit. So people do that also with an aim to give away their own money and get some tax benefit for it.
Right. Okay. So that's like giving money to charities, so they get a tax deduction. And
correct.
Funding things like that. And so why is this? Why do you think that this is becoming more relevant and more important, this responsible investing? I mean, I know we're getting asked for it, but why do you think that's happening as well?
Well, look, I think many years ago there was an assumption that if you did responsible investing, whether it was the sort of old-fashioned ethical or sustainable or ESG, you might have to give up some investment returns for making that decision. And I think today the reason why there's more and more interest in it is that people, there's a lot of people who just don't want to get richer by making the world a poorer place. Mm-hmm. So that's the first driver. The second point, and this is something we believe in very strongly at Morphic Asset Management, is that by doing these things, we should, over long term, actually be making more money for our investors and taking less risk. And I'll give you an example of that. I mean, there are industries which we think are fundamentally unsustainable that may not exist in 10 years' time. And people will scratch their heads thinking, how the hell do these businesses ever exist? And the obvious one in that case is tobacco. Oh, I'm not offending any smokers out there, but, tobacco kills you. There's not really much dispute about that. The tobacco companies tried to hide that fact, even though they knew about it for 30 years, and now they're facing endless lawsuits. So there's really no reason why companies that sell cigarettes should exist. Mm-hmm. So we think it's a real risk to invest in those companies. There's lots of temptations for risk, like the fact these companies pay quite high dividends, but ultimately if those companies cease to exist, you'll lose your money. Mm-hmm. And so our view is that by avoiding investing in companies like tobacco companies, we are actually reducing risk for our investors. Mm-hmm. And that seems to us to be fairly black and white. There's always a question about timing. We may have to wait a while to be proven wrong, but we do think we know where we're headed. Yeah. Then you come to things like corporate governance. We just think fundamentally companies with poor corporate governance are riskier than companies with good corporate governance. And best of all, we like to find companies that aren't perfect but are getting better. Mm-hmm. And then we think we're getting paid to take a risk, but we think the risk is going down over time.
Mm-hmm. Mm-hmm. And so there's a big increase in people looking for these. Just looking at some of these stats here, there's a big increase in people looking for responsible investment opportunities by the looks of it.
There is a big increase. I mean, there's in Australia, as far as we can tell, the growth of responsible investing, and this is based on data that comes from the Responsible Investment Association Australasia, and for the most part, it basically went up about 250% between 2014 and 2016, which is as far as we can get the data. But we're pretty confident it's gone up more since then. Mm-hmm. I think what's perhaps most important is that younger people really attach importance to this. So, they haven't yet got a lot of free investable income, but apparently if you ask millennials, my children, for example, they will tell you that overwhelmingly they'll tell you that the impact of what they're doing from their investments is very important to them, and they don't want to invest in bad companies that are destroying the planet because they have a view they've got to live in that planet.
Jack, is that something that changes? Is that something that changes over time, though, or do you find that some of the younger people that come in continue with that way of thinking as they grow older?
Well, it's hard for me to generalise there, but all I can say is I am now, and I've really struggled to believe this, but I'm 62 years old, and I'm hoping I'll be on this earth for another 30 years. So I have a view about the future, but I know my children who are 18 and 21, they're going to be on this earth for probably another 70 years. And I think that the idea that these issues are going to go away as they get richer for them is unlikely, because particularly things like global warming and climate change, they're really, I mean, I don't know about you, if you talk to your children, but my children actually worry about these things in a quite sort of existential way. And I think they're going to go on worrying about it more as those impacts start getting greater.
I mean, my son's 20, and he's definitely got a different view of things than you or I might have.
I think more importantly, they have a different view of things from the way we thought when we were 20.
Just back on the children, Jack, I was just thinking about that. One of the other things I think is the children are more educated than what we were at the same age.
I think they are. I think that's definitely true. It's not they're better educated. These weren't issues when we were growing up, and they are issues now. Yeah.
And we probably wouldn't have been aware of them at age 18 or 19, whereas the kids these days seem to be. So one of the major things about investing is people are looking for returns. Of course, generally they're looking for returns. So if they use this responsible investing, what sort of returns are we going to? Are we going to get lower returns, or what's the history show on that?
Look, there's been lots of academic research on this, and like most academic research, you're going to get people who can find what they're looking for to some degree. I'm sorry to sound so cynical.
Yeah, that's true.
But having said that, UBS, which is one of the best stockbroking companies in the world, one of the global stockbroking companies, they did a review of all the academic studies that they could get their hands on, and they found that actually if you combine a negative screen, that is, you avoid the bad guys, and you try and pick the sustainable companies, you do that in a single portfolio, you tend to outperform over time. Now, they're going to be very clear. You're going to get volatility in that because, to give you the most obvious example, when the oil price goes up, oil stocks go up. Mm-hmm. So if you're avoiding investing in fossil fuel companies, as we do, for example, you have to accept that you're going to go through periods of underperformance when the oil price goes up, and you'll get a tailwind when the oil price goes down. Mm-hmm. So it's going to be volatile, but nevertheless, over time, by avoiding the bad guys and investing in the good guys, according to UBS's what they call a meta study, looking at a study of the studies, they found that you did not get any lower returns, you got slightly better returns. The other thing the other study that I think we paid a lot of attention to is that it's pretty clear now that avoiding companies that have got obvious corporate governance problems is a way to avoid risk and get better returns. So that's another it's sort of a linchpin to our strategy. We don't mind, as I say, we're very clear, we don't expect perfection. The problem with perfection is that you can only go one way. Mm-hmm. So just investing in companies with perfect corporate governance is actually a risk itself. But if you can find companies where there have been a few problems, they're not fatal, and the company's recognizing the challenges and trying to make improvements, then you can hit a really very, very good place.
So what do you look for in this good and bad corporate governance? What do you actually look for there?
Okay, well, first of all, I mean, there's lots of mathematical data on this, which has some help, like, board diversity. Yeah. Having a mix of males and females on boards definitely helps. Mm-hmm. Although there are problems there, which I'll come to in a minute. Having a good majority of non-executive directors, people who are acting as custodians for the shareholders in oversight of the management, that is generally a good thing. Mm-hmm. The only problem with all this stuff is, of course, you can measure these by numbers quite easily, but the numbers may hide the detail, if you like, in each case. Yep. We're also very focused, for example, one of the side effects of quite rightly improving female representation on boards is that because successful women tend to have done best in the professions, you tend to have seen a tilt towards more lawyers and accountants on boards rather than people who actually had experience running businesses. Yep. So we want to make sure that secondary effect doesn't overwhelm the first effect. Mm-hmm. But our view is that there are a lot of companies out there selling services that will pretend to give you an ESG score for every company and so on. We avoid that. We don't invest in the whole market. We invest in individual stocks. So we do it on a stock-by-stock basis. And we're looking for, if there's been a succession of related party transactions where the management have been getting benefits from their involvement in the company that shareholders didn't get in a poorly disclosed manner. That's a real issue. And there's been a lot of controversy recently about Village Roadshow, yes. Which I'm sure you've been covering. Yep. And clearly, that we many years ago when I was at Hunter Hall, we were an investor in Village Roadshow preference shares, and we ended up having a battle royal with the Kirby brothers, who run the company and the major shareholders, over the way they were treating minority shareholders. Mm-hmm. And all the warning signs were there. We end up with what I would call a slight game draw in that battle, and vowed never to look at the company again. And if you look at what's happened to the share price recently, there's all these revelations have come out about the poor governance. Mm-hmm. You can see that the red flags were there to see. You were best to stay away.
Yes.
Jack, it looks like we've run out of time. Very interesting chat. I'm sure Stephen will have you on again somewhere down the road. Thank you very much.
Thanks, Jack.
Been a privilege. Next time I come, I want to go up to Newcastle and be in the studio with you.
You can come up anytime, Jack. I've told you that before.
I know.
Okay.
Bye.
Thanks, Jack.
Did you see what he did there, Steve? He made out like it was your fault that he hasn't been, like you haven't been invited. That's all good. Jack Lowenstein on ethical investment. And I guess in about 10 seconds, Stephen, just a different way of looking at
ethical investment's a different way. And ethical, as Jack said, ethical investment means different things to different people. You know, we've got a couple of clients who have what I call an ethical overlay on their portfolio, and we always have to check with them more in detail and what goes into their particular portfolio than other clients. Like one of them particularly doesn't like investing in shopping centres.
But someone else will be fine with that. And with
the major ones are alcohol, tobacco, and those type of things.
Good program as always, Stephen. You'll be back next week for another Thursday Finance.
Thanks for listening to this podcast from 2NURFM at the University of Newcastle. Topics range from gardening to health, well-being, pet care, finance, business and travel.